Alrighty, there we go. It's gonna give it 30 seconds to load. It's loading. Give me 1 second here. We'll start.
Uh, don't forget the link. Oh, there it is. I got it.
What's that?
I was just saying, don't forget the Twitter link, but you just sent it. So.
Alrighty, we got people jumping in now. How's everyone doing today? How are you doing today, Peter?
I'm doing well, sir, and I guess yeah, you're doing good.
Yeah, I definitely can't complain. I've got a lot of stuff to go over. A lot of stuff has changed since we've last, talked. It's been a while since we've last done a video.
Absolutely, yeah. Yeah, several months. I've lost track myself. But yeah, I haven't been online with many people at all. I've done a few podcasts, but it's really been, as I said, a kind of a crazy year to try and anticipate things and cover everything is difficult. So yeah, no, it's good to be back though.
Glad to have you back. So let's start out here. We got enough people going on in there. So one of the things I went over in my last video is if you look at the Office of Financial Research, you can actually pull up. It does monitors hedge funds, banks, all sorts of things like that. And one of the things that I showed everybody last time is their borrowing is at an all-time high, from prime brokerages to repos. It's at an all-time high for hedge funds. So they're borrowing more than they've ever borrowed. And if you look at this chart that I'm showing you right now, you can see that their assets are actually declining. They're not really moving. They're actually, the net assets going down. So if you look at their exposure, though, it is going up and up and up, and it's gone up by a notional value of 6 trillion over the last year. So they're going up at a massive, massive rate, and their assets are actually going down. So one of the things I was talking about is, with the Moass, this is actually one of the things you want to see, because this means that more and more are getting closer to leverage, more and more of them are getting more exposure. And one of the things also with this thing is right here, you guys can see that they actually increase their derivatives, what they need to put down for collateral, up to 900% for Q1. So the amount that these guys need to put down in order to take these trades out is drastically increasing. What are your thoughts on this with hedge funds, and what are your thoughts on more borrowing, Moass? Do you still believe in all of that, or what are your thoughts on all this?
Well, yeah, I mean, if you go back 3 years and the original thesis that and a lot of the YouTubers were talking about at the time, it's like, well, at some point the hedge funds are going to get margin called because it costs more to fund these positions. And what's surprised everyone, of course, is how they've been able to stay in these trades. And how do they keep doing this? Well, first of all, they were given a large amount of operating leverage by they were given very good lending terms by the banks. And obviously something like the reverse repo facility facilitated that. Um, it was very easy to get collateral. The Fed was handing out treasury collateral like, bubble gum at a birthday party, right? It's like when the reverse repo, don't forget, it's like normally treasury collaterals are expensive because there's no haircut. But when the reverse repo was in play, you could get as much treasury collateral as you want. So what happened is, then you get treasury collateral, you can borrow against that, and as a result, there's just a lot of leverage built up. Now, um, as the markets got more constrained and cost of funding went up, and the ability to get easy collateral was collateral got more expensive. So what do? Well, you need to have some really good long side asset plays, or very good short plays to work. So they doubled down on their shorts, and they doubled down on some of their longs. So as a result, you've got this ridiculous magic seven, and I Nvidia defies reality, and I think, but as in trying to short Nvidia would be a death sentence, and so no one has been trying to really stop the train. But really, it feels like an Enron situation at some point. Accounting is dubious. At some point, it will correct. But in the meantime, it serves the interest to pump this thing up and pump up related stocks. So you've got this huge amount of collateral. And, Tesla used to be the same sort of vehicle. They would, after they stopped shorting it, they would pump Tesla up and they were using it as a collateral. So on the long side, they've got gains like that. And they've obviously been using crypto as a collateral pump for, you know, especially if their entry levels were, sub 30,000. Yeah, the move up to 60, 70,000 has suited them very well. But those gains are taken away when you've got like some dogs, or you basically, as I said, the cost of funding keeps going up. It gets more expensive to keep these positions. So your amount of operating leverage is increasing, but your actual borrowing room is gone. But yeah, I mean, I don't like to I was probably guilty as anyone of getting too excited a few years ago about, margin calls at some point, like, oh my God, the Fed's going to start hiking. Well, the Fed has hiked, and yet, quite drastically, and yet nothing fell off. That's what apparently nothing has fallen off. The market hasn't collapsed, but there have been things that have fallen off. I mean, obviously things have blown up. FTX blew up. Um, Archegos was well before the hikes, but things have fallen off. It's just the whole market hasn't crashed, and there's been these emergency actions, hiding Credit Suisse's activities for 50 years. So things have been covered up, to try and paper over the problems in the markets. But really, yeah, this is a huge problem. Hedge funds have basically taken out huge exposures. The banks have facilitated this, and the banks have been suffering, and to you know so they didn't have to foreclose on these margin calls. The FDIC created a pawn shop last year so the banks could still get liquidity, because otherwise they were going to have to either cut some of their loan clients, as was happening in same thing in commercial real estate. I don't know, jumping ahead, but the same issue, huge losses of commercial real estate, but the banks were basically able to cut deals with their borrowers because they were able to get liquidity from the pawn shop. Well, the pawn shop's closed down, and a lot of those deals are basically, a lot of those loans are coming due in the next 6 months. So it's going to be problematic. And I think what you saw in terms of what happened 2 weeks ago with the reversal of the carry trade just indicates that, yeah, like some shoulders were tapped, there were some margin calls, and we had that 2 or 3 day panic. And then, of course, the Bank of Japan decided to put in $40 billion of liquidity by buying bonds again. So whenever there's a problem with the system, one of the central banks is jumping in and providing liquidity again. And yeah, like the Fed is now basically expected to cut, and that's probably helping a lot of these funds breathe a little more. That they will be able to survive at least for a few more months. If the Fed starts cutting, that means the cost of funding these positions will go down, and maybe they can start to unwind some of them. So it'll be very interesting to see how this all plays out.
Yeah, I still don't think that there's going to be any rate cuts. They seem to say that every time. They're like, no, we need a little bit more data, and the data that
Well,
they keep
yeah,
going on.
yeah. This is interesting. I pointed out in the last 2 years, you were right. So everyone would get excited, especially in front of Jackson Hole, which is the Fed's annual meeting where all the think tank guys come on. And the last few years, it's like, oh, the Fed's got to start announcing their, the whole dovish pivot, right? And yet every time the last 2 years, Jay Powell's come out and been hawkish and totally screwed up the dovish, oh, no dovish pivot. This year, like, the market's already supporting it. Like, I know you're adamant that you don't expect rate cuts, but the market's priced in a cut for September, and they've priced in a cut for December. And in fact, some people are talking about a 50 basis point cut in September. So there's people getting ahead of themselves again. But that being said, the bond market is pricing it in. And we do have FOMC minutes from the last meeting tomorrow. So we will get a sense of whether there's any kind of hawkish doubt still there. The only thing, that is going to help this narrative is inflation is finally below 3% in the U.S., which was, the Fed doesn't have an official target, but 3% is de facto top of their range. They couldn't cut before it was below that. The other thing is, and you posted this today, and I've been talking about it, in Maro is talking about it, this whole BLS data revision. Now, I've been going ape shit about this for the last few years. It's like the non-farms are always higher than expected. How can every Wall Street economist be wrong consistently to the downside for months after month after month? These guys get paid millions of dollars. They have, hundreds of they have lots of resources. Like I don't know how many staff they have, but these guys are well funded. These are marquee, chief economists of Morgan Stanley, chief economists of Goldman Sachs. These guys are supposedly the brightest and the best, and they all can't get the freaking non-farms forecast right once in 12 months. So what's wrong with them? Well, either their models are totally wrong. New age, whatever economy, blah blah, or the data is corrupted. And as we've seen now, the BLS has got to revise the job numbers for the last 12 months down by at least a million. That's the speculation. And we won't know until later this year, maybe even next year, what the actual revision is. But the BLS is now warning that the economy wasn't as quite strong as we thought. So the whole rationale the Fed can't cut because the economy is too strong, now it's been proved a crapper. And again, it's like um, there are like Bullard, who was an ex-president of forget which Fed, Midwest Fed, Chicago Fed maybe. He was a noted hawk, and he's been out since he's retired. He's been speaking on these paid public publicity tours that these guys, milk when they get out of office. Anyway, he's been saying he thinks the neutral Fed rate is about 150 basis points lower than where it is. So that would imply he thinks the Fed's behind the curve. So there's a lot of people that are saying that this thing is due for cuts, and if that does happen, that will help the Fed. Uh, I mean, I can go on for hours about this, but so there's several reasons why you need to cut. So a lot of people, including Derek, I think you might have done it as well, as pointing out the huge mark-to-market losses the banks have on bonds. And so all these guys were buying 30-year bonds and 30-year mortgage bonds a few years ago at near zero rates, right? And 1, 2, 3%. And then the Fed starts hiking aggressively very quickly, and they don't have time to get out of these positions. So they've been all stuck with these huge bond market losses. And of course, the Fed, being the biggest buyer of them all with quantitative easing, was buying crap loads, billions and billions of dollars of treasuries, at low rates. So basically giving the government near zero rate funding for several years. And now all of a sudden the Fed is wearing all these bonds and showing record losses. And Bank of Japan same, and Bank of England same, Bank of Canada same. So all the central banks have been doing the same bullshit. They've been and again, this never would have happened. Well, this didn't happen when I was at the central bank, and I was told this would never happen when I was at the Bank of Canada. But things change. Central banks become non-disciplined, and they violate their I wouldn't call it code of contact, but the whole thing was if you've got a fiat currency system, it relies on trust, and basically they violated trust. But anyway, they've issued all this debt, and now this huge mark-to-market losses. So they need to cut rates to get those mark-to-market losses back down. And the other reason they need to cut rates is because the Treasury can't afford to issue debt at like if they issue 10-year debt, they're locking in at a 4% rate. Well, okay, 20 years ago that wasn't such an issue, but now the size of the debt is so much bigger, you just can't lock in so much debt at such an expensive rate for such a long term. 30 year, God knows. They've been pushing all their issuance into the short end, but the short end's inverted right now. So you're actually paying more on your short term issuance than you're paying on long term, but you're thinking as well, rates are come down soon, so we can put up with 2 years of pain, but we can't put up with 10 years of pain at these rates. So the assumption is by central banks that they will be cutting sooner rather than later. And some of them already started. Bank of Canada's done 2 cuts. Riksbank cut last night. That's the Swedish central bank. So there are cuts coming, and there are more coming. And so I do believe the Fed will cut. Whether it's in September, we'll find out tomorrow or Thursday. So,
But I feel like I've heard all this before, Peter. They've priced it into the market before, and we're wrong,
oh
and then
yeah,
we
no,
see downturns.
yeah, no, as I said, this has been the game that the Fed pivot has been priced in 2 years in a row. But this year, I think it's more likely than it has been, just because of where inflation is. So.
The reason I just still don't see it is, like I said, you have too many people over leveraged, not enough people with assets, and you're not going to want to give all these over leveraged people even more access to easier money. When you look at the housing market, they're already losing money on loans. If you cut rates, you're going to actually hurt the banks in that asset. The Fed, it's hard for them to cut rates on everything else, and especially with the debt, because the debt keeps growing, it gets riskier. You're seeing more people get into gold standard. So I feel like they want it to. Of course, they all want that too, but there's just too much going against them. I mean, even the Fed, they're operating at a loss. I mean, there's just too much against it to be able to do a cut in my eyes. But we'll see, like you said.
Yeah, I mean, you raise good points. There's a whole problem of the phrase I'm looking for is not at the tip of my tongue, but it's not moral suasion. Um, basically what will happen, yeah, you said if you lower rates, you just run the risk of people borrowing more. And again, these hedge funds are already levered to the max. If rates come down, that may encourage them to take even more bets. It's like the mentality is, well, we're kind of fucked. We might as well go for the, it's like, you're Vegas, you got like you're down. I got $100 left on my credit card. Well, might as well take that out as well. You've already lost 3 grand. Might as well take another 100. So that's where hedge funds are at right now, right? So yeah, I do think, yeah, you're correct in some respects that that runs the risk of more borrowing, which will exacerbate the existing problems. And it's sort of like, Gen Z saying, well, I'm never going to buy a house anyway, so I might as well forget about saving and, just go hell with it. And that's the risk, is that the market maybe the point where it's like, well, the hell with it. We're gonna have a reset at some point to save me. So I can just do what the hell I want. And that if you get enough people doing that at the same time, and rates come down, it's like, we didn't learn anything from the past. We'll just do it over again. And that's exactly what we have seen since 2008. It's just been, the Fed was supposed to normalize the balance sheet between 2012 and 2014. Didn't happen. And 2017 they gave up completely. So yeah, I don't dismiss your theory either. I just think that this time the odds are more in favor of seeing cuts. But yep, your points are valid.
Well, the big whale part that we haven't discussed on it, and why I really don't think they can cut is, well, you have 7.6 trillion in debt being renewed towards the end of this year, which makes that risk factor go all the way, way back up. But if it doesn't get renewed, if it does get renewed, it's at the new rate, so your interest rate goes up. Again, it gets riskier and riskier and riskier. On top of that, you have Japan talking about selling 400 billion. They just sold 180 billion of treasury bonds. They're talking about that retirement fund that has 1.5 trillion in assets, and it's hundreds of millions in treasuries that we forced them to buy back in the day when we pretty much. And so it's like,
And you, yeah, absolutely. So you're basically talking about a buyer strike. So yeah, people that say, well, I can't, I'm not going to buy a 10-year treasury at this low rate. It's like it's not high enough. So I'm not going to buy a treasury. So that, you said you're trying to renew your debt. You can't sell this debt at the low rate because no one wants to buy it. So rates have to stay high so people will actually take your debt. The funny thing about that is, because the U.S., like, I can tell you what happens if the U.S. rates go down. It doesn't matter what's going on in the Canadian economy. Canadian rates will go down. It's like it's sort of like it's a relative game as opposed to an absolute game. So you're talking about absolute rates can't come down because no one will buy U.S. debt. But if rates everywhere else also go down because U.S. is going down, then it's not as much of an issue. And so I'm sitting here looking at the Canadian dollar today, right? And we had CPI in Canada come out at 2.5%, which virtually guarantees a September 4th rate cut. And you'd think the Canadian dollar would weaken on that, but it actually has stayed stronger than it has been for the last few weeks. Why? Because people are expecting PayPal to be dovish tomorrow and on Thursday and Friday. So it's kind of stilly. So yeah, like there's definitely an issue of rates are too low to refund the debt, but if rates are lower everywhere else, it's not as a problem. So I think that's the one thing to keep in mind.
no, I mean, that's a good point. It just, yeah, like I said, I see so much going against it toward, with, like I said, with this renewal and all this other stuff, and people are seeing the economy weaken. Um, But yeah, I mean, like you said, it'll be very interesting here to see what happens with this debt situation, because that is one of the things I did want to get into. We've already in the last week raised our debt again 106 billion in 1 week, and this is why I don't believe they can. Like I said, I don't believe they can do this rate, and like you're saying with Canada, everything. The thing is, it's like, okay, they all expect Paul to do it, but the problem is if he doesn't, like he's done the last 2 years, it throws everything all out of whack again.
Yeah, no, I know, and that's it. It just and that's the thing with like I would again, my bias is that the Fed has waited too long. The data has been too rosy, and the problem is like you see these numbers and you say, okay, it could be the immigration impact. We don't really know how many people have come into the U.S. All these people need food, clothes, shelter. They weren't here before. That increases demand for stuff, increases prices, increases activity. So maybe these job numbers are real. And then you get the BLS admitting that they're not. So it calls into question exactly how strong is the U.S. economy. And because like there's guys on Twitter that I also follow, like Macro Edge, I think is one of them. and he's always posting about job cuts. And it's like, how can you have these consistent large number of job cuts in blue chip corporations, and yet it's not showing up in the job data? So that's I I sit here and I used to be a data junkie. Like when I was in FX, every data point could mean the currency could move. So you cared about even the tier C data could move the market. So you'd always pay attention to this stuff. And in my last few years, I've just sort of gone the complete opposite. I get caught. I don't even get up to the numbers anymore. Like I used to be like, for me, 6:30 is when the data comes out. I got up at 7 this morning. I just don't care anymore because is the data real? You don't know. So the Fed and the other central banks are making decisions based on fake data. So it is a game. And so, yeah, Jay Powell could basically screw the market entirely, and you would be like, well, what the hell? What? And they could justify it by whatever data point they want. They just it's frustrating. And so, yeah, I definitely think that it used to be. I used to have a lot more faith in the overall narrative of how things traded. I mean, in equities, I've lost that a long time ago. Like at least 3 years ago, when Hertz basically was going bankrupt and people were buying, I said, okay, I'm done. And then GameStop, of course, happened, and I said, how the hell did short interest get over 100%? So I stopped caring about reality in equities because of that. And people say, oh, AMC is a fundamentally bad stock. Okay, well, no, it didn't matter because the shorts were so ridiculously exposed. And now it's like, well, AMC is a fundamentally great stock now, and yet it's not moving at all. So it's like, don't tell me the fundamentals. They will eventually matter, but in the short term, fundamentals, economic data, it's all gibberish. And so one of the reasons I really got interested in listening to Crazy Lady Trader, she basically told me, I trade basically on this as a big game. It's like see what Jim Cramer is doing, and do the opposite or whatever. But it's like it's so true. There's narratives being played, and you just have to understand what strings are being pulled. And that's what I find with the Fed now. It's like who is to benefit the most or suffer the least? And I'm always going to be biased that the banks are self-interest is the Fed's main concern because the Fed is owned by the banks. So always try and figure out what will work out best for the banks in terms of what the Fed's going to do, and that usually is how it goes. Now they had to hike rates because the Fed's credibility was gone. So that's one case where they had to screw over at least the regional banks to get the credibility back, but they don't have the credibility anyway. That's the ironic thing is no one will trust them anymore like they used to. I certainly don't. I worked for a central bank for 8 years, and everything I believed in has been totally thrown away. So I will not be working in Ottawa again, I suspect.
No, I mean that's the thing. Like all this data always seems to be wrong, revised, incorrect, or incomplete, and that's the thing. But here's the thing with we've seen it in the past. He it's always about helping the banks, and the thing is rates lowering the rates right now actually hurts the banks, which at a time they can't really be hurt. They make less on these loans, and they're already losing money on those current loans with the cost of everything. So I don't
Yeah.
believe that doing a rate is going to help anybody. It's going to because the only thing it would really help is middle class, and to me that's the thing they care about the least. And when it comes to the market, they have the plunge protection team that we've seen them use plenty of times when we thought it should have lowered.
Yeah, there's that. I'll just say that, yeah, like if lowering the rates will hurt the banks, the Fed will find a way to give the banks a sweetheart loan somehow to offset that. So, and as I said, the balance sheets of the banks will be helped by those mark-to-market losses on their bond books going down. So there's benefit. But yeah, like the pledge protection team, that's an excellent point. So anyone that was wondering, like the VIX has been suppressed for the last year, like that carry trade unwind where it jumped up to 69 from whatever it was, 20 or 35. I can't like that. We should be seeing a lot more of that. And the fact that that's how bad this unwind was in terms of liquidity, is that it got that high because normally it's been suppressed, and it's being suppressed because market behavior knows that there's always going to be someone, basically looking out for to those those gaps higher will not sustain themselves. So you can short volatility because someone will always be looking out after you. And who is that? Oh, it's the plunge protection team. So yeah, it again, when I was at the Bank of Canada, I wanted to intervene. I wanted to basically force policy down the market's throats. But ultimately, as I've seen from the last 20 years, with quantitative easing and everything else, it's not a good thing because it distorts market prices, it distorts market behaviors, and having someone constantly suppress volatility is not a good thing. You need people to just I'm not a full born like capitalism and naked invisible hand of Adam Smith, but it there is has to be there has to be losses and gainers. You can't just have gainers and gainers and gainers and subsidize that by future inflation. But that's where we're at. So the central bank
It's
has
like
to
that's what
allow.
they've been doing.
Yeah, they have to let some people blow up, and they're not letting it happen. And conversely, they're not letting squeezes happen. And again, every time I mention this, I get all kinds of loonies and people attacking me. But I do suspect that with the last offering by Ryan Cohen, it may have been the case that discreetly the SEC and the Fed basically said, hey, maybe you should do an issue. You could use the cash, and it's going to be a phone call or a discreet comment from a third party, and that's all it will has to be. It's like, hey, we'd appreciate it if you did something good for yourself and did a share issue, and it's like, and who did that benefit? Well, it benefited the GME in terms of the fundamentals, but it would have, I don't know if it killed Roaring Kitty, but it certainly took a lot of people's hopes for a quick Moass out of the way. So, insofar as I don't think the authorities want a Moass, so I think one will probably have to happen at some point because the shorts are so ridiculously overexposed. But they want it controlled over time. They wanted a Tesla type squeeze, right? That's their ideal situation. And I think if you look at how suppressed AMC and GME are right now, it feels to me that with all the risks elsewhere, they just don't want these things doing anything right now. So just keep it boring, keep all the day traders, momentum traders out of it, kill the options, and then when things are a little more settled elsewhere, then there'll be some position scoring and these, right now it's like the volume is dead. Like the AMC's volume has been pathetic the last few weeks, and it's because no one is selling of significance. The institutions are slowly accumulating, but the day traders, the option trader, anyone buying an option AMC is just getting nuked right now. So I don't know why someone would buy a 1 week or 2 week call right now. It's just, you could say, well, it's very cheap. But yeah, like, okay, if you want to buy a lottery
It is
ticket
for
every
a
week,
reason, though.
yeah. So anyway, I don't know if I veered way off your topic, but that's my view. Is like the authorities do not want volatility, and so they're basically suppressing things that might be problems, and that just builds up pressure though. So as the Bank of Japan will find out.
So, I mean, I just want to play off that a little bit here. So, like you were talking about them not wanting, I agree with some. So, one of my theories was too a while ago was if it got too bad, because okay, if you can see my screen right now, it says the world's richest 1% have increased their fortunes by 42 trillion over the last decade. One of the things that I wanted to show, we'll get into later here in a second, is it says that 9% of men have over $100,000 in their retirement. That's all 18 plus, only 9%.
Yeah.
4% of women, or 5%, sorry, 5% of women have over 100,000. So basically, everybody, the way the game's always worked is it siphons from retirement. It takes from middle class, and then they borrow, and then they still take from the feds what they can't take from us. Well, the point is if they want this, to me, a lot of people look at this wrong. It's all about keeping the game going for these guys. Keeping it going to where, they'll always stay rich. They can give the ants enough to where they're going to say, all right, you're not going to revolt. You're not going to do anything. Well, at this point, it's getting to the point where everybody's broke. All these things are coming, all these loans, all this CRE bonds, all this stuff in the back end. And if they want this to keep going, what I thought that they might have been one of the steps they might have taken if they couldn't get out of it is to keep the price lower, let a lot of people accumulate shares, and then suddenly it jumps up to $30, $40, $50. Well, that makes a lot of, in my eyes, they do want a Moass, because when you have your economy getting as bad as it is, there's only so many more ways out of it. And one of the ways out of it is to give a Moass, is to replenish your middle class. And you can't do it through a stimulus, because they've already tried it through stimuluses, and it makes the problem worse. But you can do it through a type of Moass, a squeeze, to where you let a couple big retail stocks, jump up a little bit, and that's how you replenish it, because you can keep the ants that don't understand what's going on in the market. They don't understand what happened, so they're not even going to pay attention. But but you can keep the ants fed that are paying attention enough to where they don't collectively group. So in my eyes, I agree with you that they want to control it, but I do believe that at some point they do want it to revitalize the middle class, because eventually they're going to say, all right, we've killed it off to where nobody can retire. Everyone eventually, the price of a pizza is going to be $15. People at Cub, they're going to go crazy eventually. People are already struggling.
Yeah.
So what other way to get that middle class, kind of give them enough to catch back up, other than a Moass squeeze? Because again, you can't do it through a stimulus.
Yeah, and yeah, the fares, but it has to be like fairly well distributed, and just in a few stocks wouldn't be enough. You would need it to be throughout, like basically the main indices, right? So you need to have an elevated stock market. Because the problem is that I don't know what the percentage of Americans that are actually in the stock market. It's not high enough for broad distribution of give back wealth to the middle class. So um, I don't think it's a bad thesis. I just think it would have to be like I don't know how many people are in GameStop, like how many people in AMC. It's like if there were 4 million investors worldwide in AMC, the U.S. population is 400 million. So you'd only be even if they're all U.S. investors, you'd only get 1% of people benefiting. So it needs to be a broader rise. And you could, Nutso would say to me, well, that's what they want. They need to have the rise in AMC and GME hidden in the overall green of the market. So perhaps it'll be whatever, a rising tide floats all boats, and some boats will be on water spouts, and so we'll see. I don't think it's a bad thesis. I just think it would have to be implemented on a broader scale.
No, I agree, and that's why I think it. And that's why I told everybody to be, a short squeeze is one thing, because that's the difference between me with a Moass and a short squeeze. A short squeeze is one stock, one stock going. That's why I said it have to be the major retail stocks like we talked about. It wouldn't just be AMC and GME. I'm talking COS. I'm talking, all the big ones that people were in, all the meme stocks. Some, give it a little, but they know exactly what retail owns. You know what I mean? You can go and they can choose the ones to let it go up. And that is what a Moass theory is. It's tons of people, that are tons of shorts not being able to. It's not one or two just squeezing. It's tons and tons of them squeezing to the point where all these go up to a massive, massive number that they shouldn't have done it. But I feel like at some point, like I said, when you've accumulated 42 trillion and eventually all these ants, no one can retire their work until they're 90. They can't even give their kids enough now to go get a loan, a house. Like I said, a car's now. I mean, think about how crazy that is. For some people, a car is a dream now. Like owning one is never going to happen. Renting in the United States, over the last week, I just saw there's more people now renting than owning.
Yeah, exactly. It's like, well, we can go back to Klaus Schwab, and it's like this is his wet dream, right? It's like you will rent, you will not own a car because cars are bad. You will be dependent on the state for like is this a form of socialism? It's basically you will be dependent on the state for your livelihood, and yeah, you'll be lucky to own anything at some point the way things are going. And the problem is, it's like the 1% that do control everything, are they altruistic? History would dictate no. It's like this is the thing. We've talked about this many times before. If the 1% think they can control the rest, at some point the wealth distribution will be too extreme, and they will have to deal with revolution in whatever form that takes. So I think you're right. They know, like, I mean, the Jeff Bezos of the world must realize that he can't own everything. He has to give back. Um, I think his ex-wife is doing that. So, I think there's a point where like they know for their own self-interest that it has to at least halt, or at least, we can only have 90% of the wealth, not 95. So I don't know. And you said it, your theory is interesting. So I think something like that will happen. I just don't know exactly how.
Yeah, I just feel like eventually they're going to be backed into a corner and,
Yeah.
have no other choice. But let's move on a little bit. We've been on that topic for a long time. It was a great discussion, though. I really enjoyed it. But speaking of backed into a corner, I really want to get into something here with Japan. And again, dealing with inflation. And this is another reason why I don't believe they'll be able to cut rates. Japan is talking about selling 400 billion more in treasury. They want to sell their whole remaining 800. And a lot of people don't understand that when it comes to the yen, the yen's value itself, because the country's there's nothing backing the yen. What basically backs the yen is the country's dollar reserves. And every time they sell these bonds, technically the yen weakens in a sense, because that there's what backs it goes away. They have less backing it. Well, what they've been trying to do, it sounds like, everything I've been reading, is these people, they felt backed into a corner by America, because what we did with their retirement fund, we basically forced them into buying our debt. Well, now it sounds like what I've been reading is they want to, after they sold the 180 billion, they did a ton of gold purchase. They wanted to sell this 400 billion. It sounds like what Japan wants to do now is move out of the US dollar reserve to back it, and actually start to buy tons of gold to start to back it. With
Yeah, and that's I've seen those stories, and it's interesting, right? So yeah, for where did all these reserves come from, people like me? So like, I do a quick history lesson. So back in the early 90s, Japan was running a huge trade export surplus with the US. Basically, Japanese cars were selling like crazy in the US. No one wanted Fords and GM anymore. So Japanese cars and everything else, Japanese electronics, took over the US market, and Japan was taking in huge amounts of US dollars. So this was great. And they just had nothing to do with it, so they just kept accumulating it, and they started putting into the U.S. Treasuries, and they said, okay, well, yeah, we'll start buying U.S. land, and that started freaking people out, because all of a sudden Japanese, were big landowners in the U.S. This is the late '80s, and so like, okay, Die Hard, like the Nakatomi building, that was evident of the culture, right? It's like Japanese were buying buildings. There was a movie and a novel called Rising Sun, which talked about Japanese corporates, evil Japanese corporates. So that was the whole cultural thing back then. Japanese had so much U.S. to play with, and so the assumption was back in the early '90s that Japan would rule the world. Well, uh, what happened was exactly what happened in China later. Japanese land prices, speculation in Japanese land prices when they were built. The Japanese population is falling. There was not enough people to sustain the demand. Japanese over leveraged, and the economy crashed. And so they've been sitting there in this dead zone for 30 years now, where they've been printing yen to try and stimulate the economy. And all that's done is it's made the US dollars worth more and more versus the yen. So they're sitting on these reserves that are huge. But the problem is now, again, with any fiat currency, and when the U.S. started quantitative easing in 2008, 2010 actually, sorry, China freaked out, and China started selling their reserves. They were trying to get out of depending on U.S. dollars, and so China has led the way, and Japan slowly go, yeah, we got the same issue as China. So they've been trying to diversify out of their exposure, because they, at one point they had 1 trillion U.S. dollars in reserves, and if the U.S. is actively doesn't care about debt anymore, and just seems to not be worried about printing money to spend, well, the value of those bonds are going to go less and less. So when do you sell them? And the whole theory about when you have too much concentration is you shoot yourself in the foot when you try and sell your treasuries, because you just drive down the price. So the problem is, and China's had the same problem, is how do you do it without shooting yourselves in the foot? Russia was able to do it because they only had like 200 billion, and even then they drove up yields significantly while they were doing it. So if Russia got out of U.S. Treasuries and caused a minor hiccup in the market for about 6 months, and I can't remember how long ago this was, about 10 years ago, but Russia did it. China and Japan are going to have to take a lot longer to do it. So the problem is that the U.S. is spending like crazy now, and so the risk is, even if you shoot yourself in the foot, if you don't do it, you're gonna have to amputate your leg. So they're basically saying, yeah, we got to go into gold, we got to go into something else. Who knows? They might buy the BRICS basket when it finally gets formed. They'll buy crypto maybe. So they're just trying to get out of U.S. dollars because their concentration was so high. But it has been a big problem. And yeah, as you point out, the Japanese have been printing money and buying bonds with printed money, and so there's nothing backing the Japanese debt. So the issue with Japan now is, of course, they have so much debt that if they tried to raise rates, they'll crash their economy. And if they were, they're talking about the Fed. The Treasury can't have the Fed raise rates because they can't afford to lock in 10-year rates. Well, that's the same with Japan. Japan has had rates low for 30 years. Any significant increase in rates, Japan has more government debt than the U.S. does. So it's like any increase in rates, especially on the long end, will kill the ability for Japan to do anything because they don't have the money for it. So that's why the 10-year JGB has been controlled for so long, because they can't afford their long-term rates to be. And so it's a debacle, and Japan is just a disaster waiting to happen. And this carry trade unwind was just like, the carry trade got to ridiculous size because people were just saying, well, there's no risk here. The Bank of Japan can't hike rates, and they have dollars to intervene, but they're reluctant to spend them because they're worried they're going to, and they went through like 180 billion dollars trying to knock it down from 161 to 145. So then they realized they were spending too much dollars, so they had to raise rates, and they raised the overnight rate to 25 basis points, and that caused the carry trade unwind. I mean, it's like, oh my God, Bank of Japan's cutting rates, the Fed's talking about cutting rates. So the carry trade is not such a no-brainer anymore, and that's what caused this whole thing, was Japan raising by only 15 basis points on the short end. So it's a real mess, and if you wanted to know where the black swan would be, I suspect it starts in Asia. I just don't know if it's China or Japan that does it.
Yeah, and so I mean, that's the thing. They're gonna, well, what I've been reading too is like BRICS and everything, and a ton of these other countries, and this is what, if they do sell this and Japan is successful, and they do get enough gold to start backing the yen, they start getting the yen power back a little bit more. And here's the thing with the United States is we're pretty much on the same path as them. We just announced those 30 billion a month share buy or bond buyback, so we're pretty much printing now to buy our own debt, just like Japan was. Our debt's getting out of control. We're not at their level, but at the rate we're going at 90 billion a week, we'll get there. You know what I mean?
Yeah, absolutely. You're dead on. They're playing. As they said in Die Hard, they're taking the FBI playbook step by step. So the U.S. is using the Bank of Japan playbook step by step, even though we know where that goes. It's insane. It's like you're doing the same stupid thing that Japan's done. You're just going to wind up in the same situation.
Exactly. So your rate and risk is going to keep going up, which means you cannot lower these rates. And that's what I'm saying. No matter what they want to lower the rates, everything goes against it. That says if you lower rates, you're going to make it even worse, and it's already too bad to begin with.
Yeah.
But and that's the thing, and it's like, so let's say here's the thing too that makes it crazy. So with this yen carry trade, they're borrowing yen basically at 0%. They're coming over in the U.S. They're getting 6% on assets, bonds, blah 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 around there. Well, it all blew up the second the yen gained 25% value. The assets started lowering in value. Well, if this happens and Japan's successful, the yen's value is going to go up. These yen carry trades are going to explode. And here's the thing: when JP Morgan came out, they're like, "Oh my God!" So I was doing the math on one of my two streams ago. I was doing the math on it, and it came to around, I don't think it's 20 trillion, but I think it's about 18.6. It's right around there. And JP Morgan comes out and they go, hey, 75%, and you could watch the charts and you could see the volume and how much it traded and stuff, and how much was made. There was nowhere near even $1 trillion. So the yen carry trade's nowhere near 75% unwind. Not even close.
Yeah. This is. I was like, I had to stay somewhat civil, but it's like JP Morgan is complete bullshit. That whole thing was complete bullshit. No one knew. Like, I read a lot, and the estimates for the carry trade were between 800 billion and what you say, 18 or 19 trillion. It's like, how the hell, if no one knows how big the carry trade is, and this is a trade that's been going on for 30 years. So if no one knows how big the carry trade is, how the hell does JP Morgan know it's 75% done, especially in less than a week? It's like, if it was done in less than a week, there would have been so much more dislocation. So like, I've seen some stupid comments by banks before. That was probably the most stupid comment I've seen in my entire career. And you can quote me on that. So,
well, that's just because they're getting caught with their pants down. And what happened is, what they're afraid of is exactly what's happening. If you look at my screen here real quick. Hedge funds now, So they saw the weakness going on with these banks. So these banks were basically just printing free money, right? And all these guys are like, all right, let's go. And this is what I was talking about with everybody. It's now like the hedge funds are going to war with the banks because here's the problem. These guys, their algorithms, all this stuff. There's no liquidity left, as I showed you with retail. We have no money in our 401k. So what these algorithms do is they just take liquidity. They're not biased. They're not friends with anybody. An algorithm is programmed to do specific things to search for liquidity in areas and front run and do this and that. It doesn't care who it's for. It will do it against your buddies. So now at some point, when there's no liquidity for them to take from us, they have to start taking from each other. Well, what's going on now is JP Morgan said that, and all of a sudden everybody looks over and they go, well, why would they say that? Oh, because they're one of the banks that are caught with their pants down. Now it looks like the yen carry trade that blew up markets is attracting hedge funds again. So now it sounds like the yen carry trade shorts have rose 30-40% in the last week. But what gets real interesting here is the next slide. The very next slide, it says, for the first time since 2021, hedge funds are now turning long and buying yen and trying to raise the yen. Well, what does that do? It unwinds the yen carry trade again. This is what JP Morgan was afraid of.
Yeah, that whole story was bullshit too. It's like, yeah, like they're not going long yen. That just some of the short positions are just weren't being reported. So all of a sudden the shorts and the, if you had a massive short and the short is like, if you're looking at, whatever the futures report is, it shows like long short positions. A lot of the speculative shorts are gone. So all of a sudden what's left is the longs, but the shorts, it just shows you how big the shorts were. It's not that people are going long. It's that the shorts, canceled each other out. So and yeah, like again, why did this carry trade, and like it was being unwound? Why did it stop? And so, as I said, the Bank of Japan said they're going to start buying JGBs again. So all of a sudden, it's like, oh, okay, well, we can re-enter this carry trade. So a lot of the guys that got tapped on the shoulder popped out, and some of them saying, oh, they're unwinding their carry trade. We should unwind some of our carry trade. So they all ran for the door at the same time, and we saw dollar yen collapse from 158 to 145, and equity markets puked. And then all of a sudden, it's like, oh, Bank of Japan's buying bonds again. Okay, carry trade's back on, boys. And it's just like, meat's back on the menu, boys. So let's go back and do the same stupid trade, because the Bank of Japan has obviously done their intervention, and they're basically adding liquidity again. As you said, it's an algorithm hunting for liquidity. Bank of Japan's adding liquidity. Let's play this game again. So the problem is that the fundamentals that caused the carry trade to be started to be unwound aren't going away. The Fed's expected to.
It's getting worse.
Yeah, Bank of Japan's not cutting rates, guys. It would be humiliating for them to reverse that hike. I know there was this big Japanese government committee going to analyze why the Bank of Japan hiked they hiked because they're spending reserves like crazy to try and weaken the yen or weaken the dollar, because the dollar was too strong, because they were basically, it was a no-brainer trade to keep buying dollars and selling yen, because carry trade to infinity. So they had to stop that, because otherwise the yen would have been a laughing stock, which it still is anyway. So so all they did is they just this Bank of Japan buying bonds is just re-energized the carry trade, but it's not like once they're done. Again, as you said, where's the next source of liquidity? Well, if the Fed starts cutting rates and talking about, if the God forbids the Fed quantitative eases again, then the carry trade will really blow up. So yeah, this is not over.
No, and that's what I was telling people a couple of weeks ago. I'm like, you didn't miss it. It's going to come back, and when it comes back, it'll come back real hard. It'll come back harder because they didn't learn. Like you said, they just jumped right back in on bunches. And if Japan does,
and look at Nvidia. Nvidia, since that has gone up to 11 straight sessions. That's just this is how stupid this trade is. It's just like, it's such a no-brainer trade. It's like, yeah, okay, Bank of Japan's done. Okay, it's safe to go sell yen again, you borrow yen, buy dollars with it, and go buy Nvidia. It's such a no-brainer trade, and if everyone's doing it, the trend's your friend until it's not. But until the Bank of Japan stops this liquidity, Nvidia is going to keep going up. So people get, it's like, I think Nvidia is, I said, an Enron situation at some point. But while the carry trade is working, don't get in the way of it.
Yeah, no, it's definitely an Enron. I've gone over how, and that's what's funny. It's like, they're going to keep, like you said, keep jumping in it. They're going to use it, and that's the other problem for all these guys. They're all on the same hill. They're all stuck in Nvidia. They can't get out of it because, that's their main source of collateral at this point. But the funny thing is Nvidia is being investigated by the Doge. Like 6 organizations right now are investigating them because they've lied about their numbers for the last like 12 times. They're making the shell companies. So what they're doing right now is a big giant Ponzi scheme. What Nvidia's doing is they'll make a shell company. Then they'll tell people that with the shell company, they'll tell investors, "Hey, me and Nvidia, we have a $2 billion chip deal." But the problem, what they were not really telling them, is it's 600 million in chips and it's 1.4 in cloud services and customer service and crap like that. So these guys are investing into these companies with a 2 billion, evaluation of if they have 2 billion in a chip deal. Well, all these guys are coming in there. They're getting this giant investment. They're saying that, hey, all these guys were ordering all this new money, all these new chips with all these new investors' money. But if you look at Nvidia's sheets, it's I can't think of the category right now, but it's like when you give somebody something and then they still owe you, it's sales not yet received or whatever.
Accounts receivable, yeah.
Yeah, accounts receivable. So yeah, so they got that going, and it's just skyrocketing and skyrocketing and skyrocketing, and everyone's like, okay. So then after a couple of months, these shell companies, they can't live up to the now they're the number one leader. Nvidia's the number one leader. Well, these shell companies can't live up to these evaluations. So each month these guys come in because they don't really have 2 billion in AI chips. They have 800 million. So, their progress reports are supposed to be way farther. Well, they don't live up to it, and then they don't get any more funding. They go under, sell everything, and Nvidia makes its money back. And they created demand that wasn't even there with investors' money, and then they lose out on it. It's just a fucking scam.
Yep, exactly.
But it's like eventually, like you said, that's got to get caught because it's beyond an Enron at this point. And then the guy that their number one client, CoreWeave, he was the guy that he worked at Enron under the guy who cooked the books at Enron. He learned right under him.
I know. And yeah, it's atrocious, and it's like, it's so blatant, and yet like, and yeah, and the mainstream media is like, this isn't what we're talking about. So
yeah, we're talking like trillions. You're talking like trillions in the Ponzi scheme, and they're like,
Yeah, I know. That's what I was saying. It's like the market has got to the point where I'm so disillusioned with the and like, just not getting too political here, but if anyone's curious why I keep reposting Robert Kennedy, it's he's like, I worked with one of the guys in his campaign, about this for a year, trying to explain some of the shit that's going on, trying to
he contacted me too.
Yeah, I wanted at least one of these candidates to have some idea of what the hell is going on if they really want to clean up the market. It's just frustrating. So it's just like we're gonna blow up before anyone does anything. That's my problem. It's like it's gotten to the point where it's just so huge. You really need, and forget draining the swamp. You need to basically nuke the swamp and start over. But that'll take time. So.
Oh yeah, no, I know. It's like Citizens United, dark money. Like dark money. If I was president, the very first thing I would do is make dark money illegal. Period. That's it. And then the second thing I would do is make fucking stock trading for any politician illegal. Period. You don't need to do it. Like, okay, so you're gonna, instead of doing what's right for citizens, you're going to pass bills on what's right for your pocket. Well, that's not who we want in office, and that's the problem. And then it's like, the thing that just blows my mind with these politicians, it's like, you see how little they ask for how much crime they'll commit. Oh, just give me 30 grand. I'll make 30,000 while you make 350 fucking million, but I'll just take a 30,000 bribe and go on my way. What?
Yeah. No, exactly. That guy that just caught, like that senator that got caught, it's like he had a few $100,000 in gold bars in his suitcase in his home, and it's like, like, this guy's been doing this for 30 years. It's like, yeah, you're not.
Don't forget,
very smart.
It was registered to a bank heist. That gold.
Yeah. Oh my God. So, and that's the thing. It's like, I keep thinking that if I read real Roman history, it's like, this is part for the course. You got into public office in Rome to get wealthy. So they're just basically doing what was historically, typical. But yeah, like Nancy Pelosi won't retire because it's too lucrative to stay in office. And this ultimately comes down to the voters. You guys want to make Nancy Pelosi rich? Okay. I mean, it's like, okay, I don't mind this team paying 45 million for this guy. Well, we like this guy. He's a great guy. It's like, yeah, we'll pay him 45 million a year. Okay, fine. So it's the same thing. You don't mind Nancy Pelosi making whatever 30 million a year using inside information. Okay, that's your choice, but you keep voting her in. So you keep voting for these people. And it's like, oh, well, they seemed good when they first got in. Uh, they okay, well, these people stay in, and as stay in the swamp, they get corrupted. And I mean, AOC, like whatever, she was just bragging about how she was a waitress 6 years ago, and now she's a millionaire. Yeah, it's so blatant, it's ridiculous.
Well, yeah, and that's the problem, and that's why I keep trying to tell people, red or blue don't give a fuck about you. That's the number one problem. Everybody goes, well, this side does this side does that. I'm 100% blue. I'm 100% red. Whether you're red or blue, you can have any candidate, red or blue, can be corrupt as fuck. It should be
Yeah,
based on person, not what fucking patch they wear, because that donkey or whatever the hell, the elephant, it's
yeah,
not their real patch. Their real patch is the 500 sponsors that they can't fit on their jacket that paid them dark money in the back end. That's what you should be looking at.
absolutely, absolutely.
But that's the problem, is most Americans don't look at that. They never will, and they'll just go, well, he's a Democrat, so that's where I'm voting. I'm pro Democrat. I'm pro Republican. It's like, no, like I said, if America wanted, you'd vote green every time at this point. You'd vote independent 100% of the time at this point, because red and blue's not worked for the last how long? You know what I mean?
Yeah. Oh, yeah. Just as an aside, apparently the rumor that Kamala was going to put Gary Gensler into the Treasury, that's a fake rumor spread by the Republicans of all people. So, yeah, I mean it's comical, but like it's like it strikes me as like, so people want to be parachuted into these jobs. Like Ken Griffin wants a Treasury Secretary job because he'd be able to divest all his assets tax free. It's a huge tax scam, and the under George W. Bush, God, the head of Goldman Sachs did that. Like basically, can't believe I'm forgetting the guy's name, but he basically took the job because he was able to retire from Goldman Sachs, take all his equity gains, and not pay a cent on it. So, it's not like it's a Treasury Secretary job, it's a thankless job, it's a public service job. You only get paid 200,000. Why would a billionaire want this job? Because of the tax write-offs. Anyway.
No, yeah, and like they said, we either need to pay them more if you want good candidates, or allow them to fucking insider trade. It's just such a joke. So this next thing I do want to get into, if you look, go ahead and pull my screen back up here real quick. I don't, you probably
Yeah.
didn't see this link yet. So
Oh, this thing. Yeah. Okay.
So this is the commercial real estate screener. This talks about, I've been talking about commercial real estate for a while here. There's 929 billion due this year. There's another trillion plus due next year, and it just keeps getting worse and worse and worse. And this is stuff that was, due in 2018, or taken out in 18, 19, 20, when rates were way lower. A lot of these people, there's going to be tons of defaults. And if you watch, any of the things going on right now with real estate and buildings, commercial real estate buildings, you're seeing them going at 87% discount, averaging 60, 70% discounts. So a lot of these banks they're going to go under. Well, this website here, one of the things it talks about, if you have 100% exposure, you're a risk. 200, you're a pretty big risk. 300, you're like insanely at a high risk. Well, if you come down here and look at this shows the top. You can show, way more than this, but this shows 150 banks here. And out of these 150 banks, 70 of them are over 300% leverage. Some of these are at 618%. 500, all the way down, 400 all the way down. So when these all hit, I don't see a way out of them for commercial real estate, because you're talking about almost $1 trillion, even if the Fed step in, because the thing is the Fed stepped in, and these banks here, most of these banks on this list were probably the ones tapping into the bank lending program already, and already owe billions. So at what point do they let this finally crush them?
Yeah, and to Jay Powell's credit, he did say, or sometime in the spring, that he expected more regional bank failures, and this is exactly why, because it's just the extent, like the band-aid of the pawn shop again was temporary, and it had to be, and the assumption was, well, again, to my view, cynically, is like, well, we think we're going to cut rates within the next year, so the problem will be sorted out sooner rather than later, and maybe only a few of the regional banks will get caught in this. But there's too many, and as you point out, and it's kind of weird because from my experience in Canada, we have six major banks and not a lot of smaller banks. The U.S. has been a different system for whatever 200 years, and as a result, you have so many small regional banks that are dependent on real estate for their source of revenue. And yeah, it's going to be painful to watch those go down because it's not diversified risk. It's like small communities that are going to take the hit. All these banks are basically servicing small communities. So all of a sudden, I need a loan. Well, I got to go to Citibank, New York, or whatever. I can't go through my local bank who knows me better because he's gone. Like the bank's gone. So it'll make getting loans more expensive for people in smaller areas in the U.S. And that's what sucks the most. Is like this is going to be a catastrophe for Middle America. And the whether the banks are badly managed is another story. It's just the fact is that there's just too much commercial real estate exposure to too many small banks, and there's no way for the Fed to fix it.
No, there's not. And if you look at this chart here too, also, you can just see their loans are going up, their assets are just going down too as well. So less people are deposits in there.
Yeah.
Another thing that's going on here too as well is in Florida. Well, I'm over
Oh
here in
God.
Florida. They
Yeah.
have the condos and these tons of condominiums, and none of them were they all waived their inspections. They didn't do any maintenance. They've been putting maintenance off for years, and now you have all these people that, hey, we have to do all this maintenance, inspection, or all this stuff. It's costing millions. You're now gonna have to pay more than the condo itself in fees. All these people
Yeah.
are moving out. It's preventing people from moving in. These people that own these condos, what some of them are doing is actually they took out another loan on their current condos to try and start and build a new one because,
Yeah.
but then they're going to just default on these loans, which
Yeah.
they'll take a hit on because now you're talking about damaged buildings. Um, like I said, the commercial
Yeah.
real estate is just getting worse and worse.
Yeah. And it wasn't. I can't remember how long ago it was. There was like a major collapse of a Florida condo thing a few years ago. It's like, how did
Yeah, it
this
was in
happen? Like,
2021.
yeah, it's like, well, because it was substandard material. And I mean, that's a big problem in Florida, apparently. And yeah, as you pointed out, it's like, the media. I posted a joke about this, and I got told, Peter, it's Ken Griffin won't be affected. It's all just condos. And okay, yeah, it's like, yeah, it's a big, eh, yeah, speculative problem that is I'm told it's an isolated regional thing just for condos in Miami area. So we'll see, but it's ugly, very ugly for some people.
Yeah. And then well, I just got a couple more things here. I got about 15 minutes and I got to get going here. We got to go to that appointment. So, one of the things that came out is 94, they're talking about bank risk. And another report came out. 94 banks are at serious risk. It talks about First Republic and how they had 51% of the banks were uninsured deposits. It
Hmm.
talks about now a couple of these banks here, and it talks about talked about First Republic, and it was number 87 out of the 94. You have a
Okay.
bank in New York Mellon, which is 100% ratio of uninsured deposits. State Street, our good friends, the criminals over at State Street, 92.6%. Northern Trust, 93.7. So they're fearing that when people find out that all these are uninsured deposits, you could easily have a massive bank run starting with people running like that on First Republic again. On top of that, so that could also again lead into more of these middle class banks going under as well.
Yep. Well, I said, Silicon Valley Bank, it was, I mean, there was a build up to it, but it was exacerbated by a bunch of tech guys emailing each other, having a Zoom call, basically saying, get out of this. And, within 2 days, the thing collapsed. So it won't take a lot. If someone sees something wrong with PNC Bank or, one of the big banks, said, God, at 93% uninsured losses, yeah, that's a good incentive to probably try and get out. But the problem is you have to have some clue where you can go that won't fall. That's the problem, right? If so many of these banks have such a high percentage, where's a safe bank? And
I
bad news
believe
is it's
credit
probably.
unions are most, but here's the thing.
Yeah, I was waiting for you to point that one out. So.
But here's the thing too, like I tell people, when you go into your credit union, here's the difference between credit union and city. You can walk up to a credit union and say, I want to talk to the branch manager for one moment, and just say, hey, go up to him and just say, hey, how do you make most of your money? Is it auto loans? Is it commercial real estate? He can tell you they'll literally tell you right then and there. Do they just make enough by, lending out this and doing this and, get investing into this? They will let you know at a credit union. And if they say commercial real estate, you say thank you for your time, and guess what, you just go to the next one. It's so simple. But most of them do auto loans, and it's like they're not sitting there doing these insane freaking auto loans, because most of them, the thing about credit union is they will always give you better rates, so chances are the people won't default. And on top of that, with credit unions, everybody in them has under 250,000. They're all insured. Nobody's running away because their money's insured there. And it's the difference between a credit union is they're not insured by the FDIC, which is actually underwater. They have a different insurance, and that won't go under, and that's not going to tap or get broken into like the FDIC is.
That's interesting. I did not know that, and that's really good information for people listening to that. Actually, yeah, the FDIC is basically useless, as we saw with the Silicon Valley Bank. So the whole rules got thrown out the door to save a bunch of billionaires. So yeah, I think that's a huge point. Is if they're in a separate insurance scheme, and as you said, most of the people don't have huge balances anyway, then for someone that's got a few $100,000 is worried about a bank, then that is not a bad solution.
Yeah, their credit unions are insured by NCUA, the National Credit Union Administration, unlike other banks which are insured by the FDIC, as you see, garbage.
Yeah.
So last thing, I got two things here to go into. Well, we'll just actually I'll play it all off into one big long question because they kind of go into each other, and then I'll let you go on here. So, Dario, I love Dario's information. But one of the things he talked about a while back was hold on, let me pull up this. He pulled up how the Fed's trillion pile of paper losses are turning into actual losses with all this stuff turning, been 5 years worth of high rates.
Exactly. Yeah, exactly.
So now you also have, the Fed are operating at $192 billion loss, which is another bailout form in the banks, because when they're operating at a loss, it means they're giving out to these banks, which are still gaining, which every year, they're gaining profits off that. Well, looking into that, and now like you talked about earlier, the Feds confront up to 1 million U.S. jobs vanishing in revision. Classic.
Yep.
And then, according to Bankruptcy Watch, Chapter 7 filings are up 34%, Chapter 11s are up 26%, and Chapter 13s are up 16% as well. I'm sorry, the Chapter 11s are up 26%. So every filings are going down, and then if you look at this one, annual rate startup failures have increased drastically over the last couple of years. So nobody's starting up. All these people are closing down. Nobody has retirement. The national debt, like I showed you, went up. It's at 35.167 trillion today. So it went up over almost 100 billion in 1 week. If you still look at this, you still have 102 billion owed from the bank lending program, and I showed them before because you could look at the reports on the Fed's report on how much they've received, and then you could look at what was due on the loans and when they were taken out. You could just go back on the chart and look at the dates on how much was taken out each day, and you could do the math. And I was up to
1 year loan.
Yeah, so I was up to $34 billion that was due, that was supposed to be repaid, that wasn't repaid back already. So you have billions and billions that haven't been repaid. On top of that, still 102 left. Housing permits are down, housing startups are down, housing completions are down to where we're below levels when the entire country shut down for COVID. That's how bad it is at this point. Do you believe the United States is in a recession, a depression, or where do you see the United States going from here?
Yeah, so are we going for a soft landing? I would argue, as I was stated when we started, I think the Fed waited too long, and I do think that the rates have been too high, and as you see, the bankruptcies are rising. These rates are unsustainable. There's there's reasons why they can't cut, but the reasons why they have to cut. So I think that if they don't cut, we're going to go for a recession. So if they do cut, I don't know what that does for inflation. My thesis has always been that ultimately they have to choose higher inflation because there's too much debt. So the only way to get out of this is to inflate your way out of it, or have some sort of productivity miracle, or you hide the inflation
Can I
through.
ask you something though, quick, Peter? Sorry to cut you off, but by doing that, but by giving people more access to more debt, and by lowering the rate, I'm sorry, by lowering the rates and giving them more access to debt, and by increasing inflation and the cost of living for people already struggling, now they're going to have to rely on taking out more debt. Doesn't that make the problem worse?
Yes, yes, that's the thing. It's inflation is a way of kicking the can. It ultimately costs everyone more down the road. It's like doing a payroll loan. Okay, you solve your short-term problem, but you've just made your long-term problem even worse. So unless you have a new revenue source coming in, your payroll loan will just keep killing you longer term. It'll basically financially exhaust you, and that's what inflation will do. And so the only way of hiding that is, is it just like with a payroll loan? Well, you know what? I'm going to go change my bank accounts, and then you can try and get a creditor to chase me. So well, that's what the U.S. has got to do, and they're going to have to do that by some sort of monetary reset. That's my view. But whether that reset is a gold-backed fiat or something, I don't know. But that's ultimately, yeah, the end game is they have to hide things with inflation, but that'll kill us. They have to hide the inflation.
No, and I agree, and that's the thing. Like, otherwise, we're gonna just keep printing, buying our own debt. People are gonna keep selling it, moving towards gold standard, and like I said, it's just we're on such a death spiral right now. The United States, it's insane. I just don't. But I agree with you. At some point, and we pretty much all stomped their CBDC idea. But like you said, you're gonna either have to go back to a gold currency, and this is the thing, and that's why, like, so for the last 3 years, I know you've been a lot into silver as well, but it's like I've been screaming to get gold to keep that as your safe haven. Since we've been talking about it, it's gone up to $800.
Oh yeah, I have to interrupt you here. So back in March, I posted about how AMC was going to basically reschedule its 2026 debt, and there was some vocal like criticism of me on Reddit. And so one of the guys said, "Well, I listened to Han on a Bigum's call, and he sounded like a gold bug weirdo." Yeah, well, since that time, gold's gone from 2000 to 2550, and so yeah, I'm using Goldbug Weirdo now as my call sign. So thank you, Bigums, for your space calls.
Well, that's the thing, man. It's like you were talking about with Crazy, and her way of trading. The way I've been making more than before is I've been doing like event trading, watching, and that's the thing. Like, so, like, for example, the spot Bitcoin ETF. Well, instead of buying Bitcoin, I knew it would all raise a drop and then go way up. So it's like, instead of buying Bitcoin at such a massive price, I told everyone get Coinbase because it was a custodial to everything, and it went up 120. And it's like, you can also look at the spies and everything, and spy plays are always to me, that's the safest way you can make money is you playing the spy.
Yep, yep, absolutely. I don't have time to discuss it, and you gotta go. But I was just talking to a quant guy yesterday. He was trying to get me involved in his algo, which basically looks at entry and exit levels on a daily basis on SPY and things. He basically hunts for volatility and potential quick moves. So I think that's exactly it. It's like you can make consistent money in certain markets. You just have to be disciplined.
No, exactly, and like that's the number one thing you got to learn. It's like green is always good, and you can always come back into it. You can always re-enter a trade, but you can if when profits are there and gone, they might not come back. So don't be greedy. Exactly. It doesn't need to be 1,000% every time.
Nope. There was a book written by GM. I can't remember the guy's name, but it was Small Wins. Basically, if you get a single or bunt every day, that adds up to several homers. And just you can't always go for the glory trade.
No, I agree. That's the best way to look at it. And like a lot of my buddies say too. A lot of the problem is people will be like, "Hey, I need to make X this week, this month, this," and they'll get close, and then they'll lose it all because they had to get that little extra. It's like, no, you can't do it that way either.
Yep, exactly.
But thank you very much, Peter. I appreciate it. I want to do this again soon. I mean, we used to do it all the time, weekly. So if you want to get back, getting into doing it when you can, that'd be sweet.
My schedule probably allows it, once a week. around this time of the day is usually good. But yeah, like you keep in mind, yeah, your kids. So that kid comes first. So whenever you can, I'll
Oh
be
yeah.
happy to try. Yeah.
No, I appreciate that, my friend. Well, thank you very much. You have a good day, and I've got to get going to the doctors here.
Hey, have fun. See ya.
All right, everybody. Thank you guys for listening. I got to get going to the doctors here for little man. So thank you, everybody. Have a good day. I'll be going live here again in a couple of days. We do have a lot of other stuff I want to go over. A couple other scams they got going on here. So we'll talk to you guys soon. Thank you very much. Have a great day.